Welcome back. Let's look at world markets, starting off in Asia. By the close, markets were struggling on concerns around the economy. That's despite last week's better than expected data. Selling by foreign investors weighing on sentiment in Japan. The Nikkei down more than 0.5% and the Hang Seng down by a similar margin. In China, the Shanghai Composite down by 0.5%. Over in the United States, Wall Street lost ground on Tuesday with risk-off sentiment weighing as the U.S. Federal Reserve convened its much-anticipated two-day monetary policy meeting. We'll talk about that shortly. All three indices ending the session lower. The S&P down 0.5%, the Nasdaq as well, and the Dow Jones Industrial Average fell by 1/3. Okay, it's all looking a bit better at the moment. The JSE is trading higher. The all-share index has added about 0.4% to 74,122. The industrial index up slightly. Financials gaining more than 1%. Markets in Europe are also firmer, so we're following the global trend. The FTSE in London climbing 0.7%. Germany's DAX up 0.5%, and the CAC in Paris up 0.4%. Let's look at commodities now. Gold is trading at $1,932, platinum at $938 per ounce, while the price of Brent crude oil is at $93.57 per barrel. The rand is holding pretty steady, 18 Rand 92 to the dollar, where it's been for the last day or so, 23 Rand 39 to the pound and 20 Rand 25 to the euro. Now, the picture may change, of course, because the decision of the U.S. Central Bank, the Federal Reserve, regarding interest rates is waited for around the world. To discuss, we're joined by Jamil Ahmad, Chief Analyst at Global Trade Capital. Joining me now. Thank you, Jamil. So, no change expected, but what will you be looking for in the rhetoric of the Fed Reserve around what could happen in future?
So wait and see mode. However, we do have the case where the Federal Reserve might annoyingly keep the door open for future US interest rate increases. And I say annoyingly because all of us global currencies, whether we're sitting in the United Kingdom, Europe, South African Rand, for example, we're all quite fed up with the stronger US dollar. However, the devil's in the detail, and the details are showing that the US economy continues to perform resiliently despite any global economic concerns, whether that's high interest rate policy, inflation uncertainty, the sudden surge in oil price. And we think that actually the Fed might carry the same message from the European Central Bank last week. If there's any threat that they are going to repeat the narrative that's building that inflation will remain higher for longer, this builds the case for higher interest rates for a longer period too, which not only doesn't weaken the US dollar, which is what we're looking for, it actually opens the door for maybe a future potential US interest rate increase. This isn't priced into the market, and if Fed Chair Jerome Powell signals so much today, we could still have a further round of US dollar strength.
All right, and we always react very differently to the dollar. We go in the opposite direction. So if the dollar strengthens today, more rand weakness on the cards. Surely the oil price is adding to the case that the Fed may make.
You're absolutely correct. Because of this oil price shock, oil prices have moved higher by as much as $10 just over the past 1 or 2 trading weeks. We have global inflation concerns, and this is the shot in the wrong arm. This isn't the injection that we want, because this in turn actually means that inflation is going to remain higher for longer, not just because of paying more for petrol and imports at the pumps, but it builds the case for the central banks to be concerned that rather than inflation going on to a downturn into 2024, which was the case that was building, that's why you see this narrative around a potential soft landing. Instead, we could see inflation flatline on a higher level than we all like to see. And this, again, it builds the case to keep interest rates higher. Although the consumer economy is already suffering, we've had the biggest shock in interest rate policy in terms of aggressive interest rate increases that many of us have seen in our lifetime or generation. And this is why the case is there that the higher oil price shock actually is the negative thing and adds into the mix of a nasty drink, so to say.
Just picking up on something you said earlier, that the US economy is looking resilient. Our analyst yesterday was saying it's extraordinary that there hasn't been a global recession. Remember when we were all fearing that there could be a potential global recession because of the aggressive rate increases. But are you actually saying the signs are there that the US economy could withstand even more rate increases?
Unfortunately, that is the case, and it's a problem for all of us because my voice, I'm coming from the United Kingdom, Europe, and so forth. We see the data, and the data spells out very clearly that developed economies cannot handle higher interest rate policy. The same can be said in emerging markets. They're struggling enough with inflation as. However, if you look on the other side of the coin, the United States, yes, we see a slowdown, slower economic growth, but overall growth is high, and we have actually a divergence growing, which is the spread between US economy is still performing relatively well, robustly, resiliently. However, we have a lower risk warning here, or a higher risk warning, that other economies are not able to handle the speed. So in some ways, the United States is carrying the torch for the world economy, but will not be able to catch up. And in turn, we might not be able to catch up until the Fed starts to acknowledge lower interest rate policy. And unfortunately, recent events such as the oil price suggest that it's not going to be the case.
But on the other hand, reportedly the fall in inflation in the UK has been pretty significant. Does that change anything?
Not necessarily. We see a little bit of a temporary relief. I'm a Manchester United fan. I know everything about temporary relief because my team was doing very well that season. This season's been absolutely horrific so far. And in turn, the projections actually is that inflation in the United Kingdom is going to average somewhere between 7%. That might sound like a random number, but that's more than 3 times the Bank of England's target. And it comes at a time where if you look at the differences between the UK and the US, just in terms of housing market, UK housing market is 2-year and 5-year fixed term mortgages. That's the mainstream. The United States is more 20 years plus. We're already at a point where many in the United Kingdom cannot afford their mortgages, where defaults are a risk. And the longer that this inflation whirlwind continues, the more risk for the United Kingdom economy. That's why the British pound has fallen to its lowest level in more than 3 months. And in fact, we haven't really had the British pound in the lower 120s for many years, but we're going towards that being many years and turning into a longer period because of the concerns over the world economy.
All right, so the boogeyman inflation really haunting global markets, and we're expecting no change today, but it could affect what happens in future.